So, following on from last week's two accountants, I have the pleasure of welcoming Tom back. So, welcome back, Tom.
Thanks, Mark.
So, as promised, we're going to jump in and look at limited companies.
The first thing that we'll be looking at is we'd like to just make some comparisons between limited companies and other structures, primarily sole traders, just looking at some of the benefits and drawbacks of each.
So, what are the comparisons between the legal statuses of them both?
So, a limited company is a separate legal entity from its owners.
Yeah, and just in respect of a sole trader, the business and the owner are treated as a single legal entity.
What's the difference with setting them both up?
So, setting up a limited company is a formal process which requires legal work to be completed. So, the most straightforward limited company would cost between £15 and £30 to set up, with a more complex one being upwards of £1,000.
So a sole trader is simple and generally free to set up. There is a notification to HMRC. Other than that, they're straightforward.
What is the difference between paying yourself between the two?
So paying yourself as a limited company tends to involve a salary which is linked to the personal allowance set by the government, and the remainder being withdrawn as dividends.
So a sole trader is simple. They're paid through drawing down on the profits.
What is the difference between the national insurance for the both?
When operating via a limited company, the national insurance liability tends to be triggered by Class 1 on the salaries set for the owners of the entity.
Sole traders are charged Class 2 and Class 4 national insurance on their profits.
What is the difference with tax returns?
So the limited company will have to, in most cases, file a CT 600, whilst the director and shareholders of the company will most likely have to complete a self-assessment return also.
A sole trader would just have to file a simple self-assessment tax return.
What's the difference in the tax efficiency between the two?
So it's very difficult to boil that down for a limited company, but generally the limited company gives the owners of the entity an opportunity to shield profits from high rates of taxation.
So a sole trader isn't necessarily of a low tax efficiency or a high tax efficiency. At lower levels of earnings, it's generally the most tax efficient option, and as a sole trader's earnings increase, it decreases in efficiency.
Is your company name protected?
Put simply, for a limited company, yes, given that it's registered at Companies House.
So a sole trader, generally, no, or it's harder to defend or protect the company name.
Of course, in both options, there is the option of taking out a trademark on the business style and branding to prevent such an argument as to whom has the right to use a business name.
Is your personal finance liability protected?
Yes, with reference to a limited company, your personal finance liability is protected, not outright, but certainly more so, given that the limited company itself is a separate legal entity from its owners.
So with the sole trader, the simple answer is no. And just to bring it back to limited companies, that would be the case unless there's a personal guarantee.
Yeah, of course. So ultimately, and again, a misunderstood area of insolvency, which tends to trigger this personal finance question. If a limited company is wound up, it is possible for the owners to be made responsible for the liabilities of the company if it can be proven beyond any doubt that the structure of the company or the officers of the company, i.e. the directors, have run it incorrectly. So yes, there is that protection there, but it's not carte blanche.
What is a limited company?
A limited company is a type of business structure where the company has a legal identity of its own, separate from its shareholders and directors. They are also limited by shares or guarantee, limit the financial guarantee of the members to the value of their investments or what they guarantee. So, unlike a sole trader or a partnership, the owners of limited companies are generally not personally liable for the debts of the organisation. An incorporated business means that the company has its own legal personality. Since it's a legal entity in its own right, the business can enter into contracts and can be held accountable for any liabilities rather than the owners themselves.
That's quite impressive that that the company has its own legal personality, because that doesn't even go for some people we get to meet. So I'm impressed that a limited company has that own right. So well put there, Tom.
What are the types of limited companies?
The majority of limited companies are private companies limited by shares, which is a non-public company whose ownership is structured through shares. This type of company can retain profits after tax and distribute these to shareholders via dividend payments. Private companies limited by guarantee are generally not-for-profit organisations. Instead of having shareholders, this type of company is run by guarantors whose liability extends to the guaranteed amount. Any profits are invested back into the company. Public companies are similar to private companies limited by shares, but they must have a minimum allotted share value of £50,000. These shares can be offered for sale to the general public.
What are the advantages of limited companies?
So following on from the key comparisons earlier, aside from the core benefits of having their own legal entity and protecting the individuals from personal liability for debts incurred by the business, limited companies also have other advantages. Tax efficiency, where profits can be ploughed back into the business rather than having to pay excess tax. Raising capital, where shares can be sold to generate new capital. There is generally more credibility because limited companies are sometimes seen as having more of a professional image when compared to sole traders. Also, once the company name has been registered with Companies House, it cannot be used by another business. Now, Tom, obviously I've just said there that limited companies have a more professional image, and that's quite rich coming from somebody that works in the limited company department. I just want you to highlight the point that this is obviously not an anti-bias sole trader podcast. So you represent plenty of businesses that are more than credible and are sole traders and partnerships.
Yeah, definitely. We do have a large number of clients who are sole traders or partnerships. Those are both unincorporated entities, and they've got their benefits in their own right.
Mm-hmm.
So what are the disadvantages of limited companies?
So, I mean, one of the main disadvantages for clients, something that people find the most difficult or the most relevant drawback to them, is just the increased level of compliance. A sole trader's filing requirements are fairly simple. It's one annual tax return per year at the moment prior to MTD.
Yep.
A company would have a set of account to Companies House, a confirmation statement, a company tax return. That is a put off for a lot of people.
Yeah, and also on that point, when you mentioned Companies House, there's also that degree of public scrutiny, which of course could be deemed a positive, but it's possible for anybody to go onto Companies House if they know the company name or the name of one of the directors, search it, and then from there start some sort of digging process. So you are open to public scrutiny in a way that as a sole trader and partner that you aren't.
Yeah, I mean, there's a number of businesses that are sole traders and partnerships, and you'd be none the wiser.
Yeah. So just one point to cap off the Companies House issue. There is a further change for limited companies coming through, which will require them to disclose their profit and loss account, which again, we're working with clients and informing them of that. But for some, that would probably be enough for them not to want to do that and perhaps accept paying additional tax or not quite having the control on the profits as well, because if a competitor can understand a little bit more about them, that might not be quite as important as saving a little bit of corporation tax or income tax as the contrast as maybe presented to them.
Are the key factors that would need to be considered when deciding between staying as a sole trader or incorporating?
So there's a couple of points that I'd probably start with. I think these are the easiest. This is the easiest place to start from. You probably want to be looking at levels of profit, the amounts of tax that are being paid, the responsibilities of the people in control of the business, and whether personal liability was a major issue. For example, if the business doesn't rely on lots of credit, limited liability might not bring as much benefit as it would for another business that heavily relies on credit.
Yeah.
So a sole trader retains all of their earnings after tax, which is paid via the self-assessment system. So that's your personal tax return for anybody who already completes ones. So this means that your earnings are entirely dependent on your performance that year. So while there's the potential for large profits, there's also the risk that you won't make enough to earn a decent living.
Yeah, of course. There's certainly a need to understand when you have a limited company why the profits are presented to you in a certain way. There's there's nothing more straightforward than somebody saying to you, this is your income, this is your expenses, this is what you made, and this is the tax that's due to be paid on it, and the rest is yours, which essentially is the sole trader partnership presentation of figures, where to get the benefit of having a limited company, you are in this unique position of receiving a monthly pay slip that isn't representative of what you take and need to live, and then presented with dividend vouchers after the year end or around the year end to ratify the amount that you have taken, and this confusion, why can't I take that? Well, it's money that you've already had, and it certainly to go into it and understand it and therefore reap the benefits of it, you have to go slightly deeper than you would have to as a sole trader and partnership, and rightly so for some people. That's enough for them to just say and respectfully say, thanks for presenting the benefits, but I'd rather just keep life dead straightforward because that's how I like things. And that's not an ageist thing either. We see, we have a broad spectrum of clients across the two offices, and it will be fairly mixed as to what age range accept and want a limited company, and those that are happy to remain as sole trader and partnerships. And it's our responsibility to give the options and present the difference between the two, and then for the individuals, the clients, to decide if it's for them. And I know that's a process that you take up routinely with clients at Lincoln.
Yes, I mean it really depends on what people value as the most important thing to them. I mean, for some clients, the tax saving is enough.
Yeah,
that's the convincing factor. For some people, limited liability is the convincing factor.
Yeah.
They rely heavily on credit. It's an attractive feature. And on the other hand, with the sole trader and partnership structure, sometimes the simplicity of it, the privacy of it, is the convincing factor. That's what keeps people in that structure. It's not a hard and fast rule of this is better in this situation and this is better in this situation. It really depends on the context, on the client, where it is that you want to be.
And even going into the point that you decide to do that, most people start their business as an idea and then sometimes surprised about what comes of that, i.e. the success. And then with that success, they're wanting to expand their business or their personal wealth, i.e. buying a bigger house, for example, or changing car, and even down to the moment that you decide to incorporate your entity can be relevant, because institutions such as banks, if you was to go from being a sole trader to a limited company, that can for them sometimes reset the clock as to that existence of the business. And that's something that I feel needs to be understood more when you're maybe a year or two into your journey and somebody's presenting a saving of corporation tax or income tax, the comparison, should I say. You need to fully understand that most people, because of this recognition of it being a separate entity from the owners, will treat that as the case for finance purposes. And again, that's something that you highlight, I believe, Tom, isn't it? As a full picture when somebody's considering it, this could impact things on a logistical basis, both for the business and for the owners of the business, which in most cases is the same person.
Yeah, I mean, it's not always the most simple consideration. In some instances, it's almost the obvious choice. But like you say, on finance, for example, individuals looking to obtain a mortgage, it may not be the best option.
Yeah.
It really depends, and that's something that we can discuss with the client. We can look at the wider picture, we can look at everything, and we can see, which option is the best choice.
Yeah. Okay, great. Thanks for that, Tom. Okay, hopefully that's given you a bit of an understanding on limited companies. So thank you, Tom.
No problem.
And also thank you, Sophie, for posing the questions that the clients ask.
No problem. Next week's topic will be talking about VAT.
So that's a goodbye from me, Mark.
And a bye from me, Tom.
And a goodbye from me, Sophie.